Welcome to our 2022 mid-year report card. My name is Brian C., and I'm the founding partner of Capital Stewards. We are professional investors who help professionals from other fields make smart, long-term investing and financial planning decisions. Today, I'm going to share our view on the markets, performance so far in 2022, and most importantly, what investors should be focused on as we head into the second half of the year. So let's dive in. So let's take a look at what's happened so far this year. As most of you are probably aware, stocks and bonds are down significantly since January. The S&P 500, which is a measure of large companies in the United States, is down almost 18%. The same is true in Europe and in emerging markets. And yields, which is the return on treasury securities, are up. They doubled in a lot of cases in the first part of this year. And so that means bond prices have fallen. Really, from an asset perspective, the only thing that's really risen significantly so far this year is oil. And we'll talk about that a little bit more as we get into the presentation. But instead of getting too myopically focused on what's happened just in the last 3 or 4 months, I think it's really important that we zoom out because, as always, the best investors make really long-term investment decisions. And so it's important to zoom out. And if you've seen any of our other stuff, you'll see this frequently and kind of understand where we are in the arc of history and markets as we go forward. So looking at the long term, the S&P 500 is earning close to 9% on average every year since the mid 90s. I think during downturns, it's especially important that we look at prior peak to trough declines and use that to help us inform where we are today. For example, even if you had invested in stocks, which are the red line on the chart, or bonds for that matter, the green line, at the height of the tech bubble or right before the great financial crisis, or even right before COVID, you would still be a really happy investor today. You have long-term investment goals, and therefore it's important to look long-term, have long-term perspective, and a long-term investment plan in place to accomplish those things. If we zoom in just slightly over the last decade, you've likely still experienced a really significant stock market returns. Even after this year's market downturn, the S&P 500 has returned north of 13% over the last 10. You see followed by real estate, which has compounded significantly as well. Bonds and gold have slightly underperformed inflation, but risk assets overall have done really well. We saw a really historic rise in stock markets, particularly coming out of the COVID pandemic. And so now some of that is reverting back towards long-term averages. But as a long-term investor, your portfolio benefited from the upside of the last couple of years. So your long-term investment goals, if they were really well planned and you had a well-constructed portfolio, should still be on track, even with a challenging start to 2022. If you aren't sure about your goals, we'd recommend that you talk to a professional like us or another one that you trust to build a solid long-term investment plan as you go forward. As we expected in our 2022 forecast titled Rising Rates Will Impact Everything, rates have risen this year. And so why are markets down in 2022? Rising rates are the answer to that. The 10-year Treasury bond yield, which is a good measure of the return that investors expect on sort of risk-free assets of the US Treasury, it's more than doubled since the beginning of the year. We moved from 1.5% to just below 3.5%. And that's caused that prices of many assets, including stocks and bonds, to fall. What's causing rates to rise? Inflation. Food and energy prices are responsible for some of the moves. Certainly, that's been in the news. However, core CPI or core inflation, which is the green line, and that measures inflation excluding food and energy, is up more than 6% for the year. And as you can see, that's historically a very high number. Prices on all fronts were trending higher before the Russian invasion of Ukraine, so that was likely the cherry on top of an already challenging situation where global demand was growing faster than supply can catch up. That's especially true in energy, where years of underinvestment in sort of old school energy sources like coal and oil have caused shortages in supply now that COVID is over and the economy is normalizing. So we'll discuss that a little bit more as we dive deeper, but inflation clearly has been the core cause of rising rates. And I think there's still some question as to the core source of inflation out there. And I wanted to take some time to dive into that and clarify what's really driving the inflation numbers, because it's important as we think about the impact to the economy and future investments. It's clear that while shortages exist in a limited number of supply chains, the real issue is that demand has outstripped production. If you look at manufacturer shipments, which are on the left side of this page, we've compared pre-COVID levels to where we were coming into this year, actually 12/31 of 2021, so the end of last year. And except for a few areas like textiles and vehicles, the supply chains have largely sorted themselves out, and manufacturers are shipping more goods than they did before the COVID crisis started. So we can't really blame supply chains for everything that has transpired. On the other side of the page, you see the balance sheets of global central banks, which is a good proxy of the money supply. And as you can see, almost all central banks expanded their money supply significantly during the COVID recession to try to prevent a greater financial contraction. And if you look at the expansion that occurred during the COVID crisis and compare it to what happened during the global financial crisis, it makes the global financial crisis in 2007, 2008 look like a hiccup on the chart. So from a policy perspective, whether government representatives in a country spend or whether the central bank itself stimulates the economy by printing money and sending it in through the banking system, it shows up on the central bank's balance sheet. So all of that money needed a place to go, and it showed up in assets like stocks and crypto over the last couple of years and in everyday goods purchases. And since many businesses were running lean due to COVID, they weren't able to expand and keep up with all the demand that was caused by the stimulus that was put into the economy. So we have demand-driven inflation. So now the Federal Reserve and other central banks are attempting to reverse course and tighten conditions to slow down that demand and to dampen inflation. You can see the Federal Reserve has raised rates already this year, 1.5%. Markets expect that to continue. You see recessions on the chart often following rate hikes, but that's not always the case. And we're going to talk about this some more as well. If you look at hikes in the mid 1990s, it took more than 5 years for a recession to actually happen. And that happened after the tech bubble burst. And so was probably not completely due to the interest rate environment. So it's not a foregone conclusion that rising rates will cause a recession. The Fed's move, however, will absolutely slow the economy. And so it's a difficult question to know whether or not we're going to get a recession. Market forecasters see the odds of somewhere between 30 to 50%. So that's about as helpful as flipping a coin. But our own view is we don't really need to know the absolute endpoint of rates and GDP growth, which is the demarcation of a recession or non-recession. We just need to know whether or not the Fed's medicine for inflation is working and whether the economy is slowing down. And you can see from core labor demand that rate hikes and expected future rate hikes have started to flatten out the demand between job openings and available workers. Job openings are the red line, and the available workers or unemployed workers are the yellow line. And you can see for the first time in modern history, those two things inverted on the backside of COVID. And so we have more job openings than we have available workers. That gap has stopped increasing, but it remains really, really large. The technology sector is just maybe the most visible tip of the employment iceberg. There were 17,000 startup layoffs in May, another 11,000 so far in June. So there's evidence that tightening is slowing business investment. Some expansions and business fundings that happened in the past 2 years are not going to continue going forward. But clearly there's a lot more work that's going to have to be done on this front before we have true balance back in the labor market. The other thing we can look at is leading indicators of economic activity. And these are things like new manufacturing orders for consumer goods, building permits, along with investment markets. They've started to move down, but they have further to go to signal that there's a true contraction happening in the economy. So the Fed interest rate rise is making an impact, but we're not really all the way there yet. So the economy is showing signs of slowing. It's not in a recession today, and we think lower growth is going to be needed to offset the pandemic and get things back in balance. So the next logical question is, how much will the Fed have to raise rates? And when we think back to the core CPI number that we were talking about a couple of minutes ago, which was 6% year over year, vehicle inflation, which is one area that is challenged by lingering supply chain issues, is responsible for a little bit more than 1% of that. So if we back that out, then that means the true core economy that the Fed can control through interest rate raising is about 5%. The Fed can't fix the supply chain issues. It can't make more cars. It can't make more oil, but it can slow down the core demand issue that it created by flooding the economy with money during the COVID pandemic. So if core demand is running at 5% annually, history shows us, and if you look here at CPI, which is the red line, and the green line is the effective funds rate. If you look at those things historically, in order for CPI to slow down when it has gotten to peaks, you see that the effective funds rate has had to get to levels that were at or above the CPI for that to happen. And so it seems like the federal funds rate would need to go higher materially in order to slow down inflation. In fact, the Fed and market participants still don't believe that rates need to go higher, at least not much higher than 3 or 4%, just like they were at the beginning of the year. Markets are also still only expecting the Fed to move rates maybe up to 3.5%, 3.75% by next year. So the Federal Reserve Board expects about the same. You can see on the dot plot, which is where they survey the members and say, hey, where do you think we need to raise rates to? They're about 3.75% at the peak in 2023. Nowhere near the 5% level that it seems history would show us that we need to be at to start to cool inflation, given where the economy is today. The Fed also watches inflation expectations, and those have moved up significantly since January. Consumers now expect 1-year inflation to be 5.3%. And so whether you believe the Michigan consumer surveys or the sort of informal survey of your friends, your family, and your neighbors, most people believe that inflation is really hot, but it's going to be above 5%. And so we need to see rates above that level in order for inflation to go down. If that move higher, another question that comes up is whether the move higher in rates will cause a recession. And again, it's not so important for us to know from an investment standpoint whether we're going to get a recession or whether we're going to have a slowing economy. We just need to know that the direction is slower. It is important to have a good grounding on what recession really means. We did a podcast episode on this. I think it's sort of the R word, a dirty word, recession. And I think for many mid-career professionals, that's for good reason, because the recessions that we have experienced recently have been really bad by historical standards. They were caused by significant abnormalities in the economy. That was the overinvestment in housing stocks or housing prices in the United States in 2007, 2008. A lot of the financing that was geared around that in the mortgage market and mortgage-backed securities. That led to a significant deflationary shock in 2007, 2008, and the beginning of 2009. And then we had a government-imposed immediate shutdown of the economy for COVID in 2020. Normally, when the Fed causes a recession due to an overheating economy, which you can see several examples of on the chart if you go back in history to the 70s, 80s, and 90s, the recession is both short and milder than what has occurred in recent memory. So a recession, especially by historical standards, should not be a reason to abandon your long-term investment plan. And I would not immediately equate the recession that we could see here to something like the financial crisis or the COVID recession. It's likely to be shorter and more mild. Let's focus on oil for a moment, since gas prices are a concern for everyone across the economy. Oil consumption is back at pre-COVID levels, and U.S. refining capacity is not. And so that clearly creates a mismatch, a supply-demand imbalance, and that's going to result in higher prices. Refineries were underinvested in during the last decade following 2010 because oil was cheap, and so integrated oil companies were losing. Investors wanted to focus on new energy, renewables, ESG, all those sorts of things, and that results in an underlying loss in refining capacity in the United States. As with most areas of the economy, trying to force uneconomical activities usually results in a snapback to reality. Eventually, a lot of those new energy sources will likely be profitable and scalable, and we will move in that direction of sort of more green energy. There's nothing wrong with that, but they're not there today. They're not scalable, they're not profitable, and so rising demand for and limiting refining capacity to invest in other things results in really record low oil stocks, and you see that in the upper right-hand chart on this page. So we're actually making more oil in the United States than we made last year, just not enough to keep up with demand. Again, we have a demand problem in the economy. A lot of folks wonder if OPEC will be able to sort of bail us out. If you look at the chart on the bottom right of this page, you'll see that the excess inventory that OPEC has is more akin to where it was in the 2008, 9, 10 time period, not the last couple of years where they had a lot of oil that they could put on the market to try to influence the price. So the solution really to oil prices is a long-term one. Hydrocarbon energy, coal, oil, gas. The production needs to increase in the US. We need an increase in refining capacity in order to bring prices back down. That's a long-term solution that takes months and years, not weeks. It's not a short-term solution. The resolution of the Ukraine invasion probably will reduce some short-term pressure, but that still probably leaves oil above $70 a barrel long-term, and that's conservative. It could well be $80 or $90. It's not going to be in the 40s or 50s, a barrel that we grew accustomed to seeing in 2016 through 2020. So longer term, we expect oil prices to remain more elevated. So what does all of that mean for stocks and investment markets? There's two key inputs to stocks. We've talked about this before, right? Profits and valuation. Valuation is simply the price that we pay to own a piece of those profits over the long term. As you can see from the left-hand side of the page, profits rose materially coming out of the COVID pandemic. That trend continued earlier this year. However, valuations on the right-hand side of the page have fallen substantially given the rise in rates that we covered earlier. The rising rates impact everything, like we said at the beginning of the year, not just bonds. So going forward, earnings estimates have been moving lower since the end of the first quarter. It's the largest decline in estimates since the COVID pandemic, but we've had this really unusual rapid increase in estimates. So analysts are expecting company profit growth to slow down, which it makes sense because they've been unseasonably high. Profits are more likely to grow slowly over the next couple of years. Year-over-year earnings growth maybe looks something more like 4%, which is what we've seen historically, not 10, 11, 12%, something like that. Low PE ratios are the most important metric that investors use when they do quantitative investing and in quant screens. And there's good reason for that. It's because valuation is the most correlated with stock market returns over time. So if I'm looking for something to predict the stock market, valuations, there is no perfect predictor of the stock market, but valuations have statistically been one of the better ways to do that over time. So said differently, average valuations have led to those average returns that we talk to and anchor around in our portfolios. Low valuations tend to lead to above average returns, and high valuations lead to below average returns. So we want to buy at low valuations and sell at relatively high valuations. Natural rebalancing that we talk a lot about helps ensure this process over long periods of time. As assets appreciate, we sell them. As assets depreciate, we buy more. That helps ensure that we're buying when things are at low valuations and selling when things are at high valuations. So given that valuations are hovering around historical averages, investors should be considering rebalancing portfolios back into neutral stock positions if you're underweight, and you likely are if you haven't done anything since the beginning of the year because stock prices are down so much compared to where we were in January. I think this is also an opportunity for us to look at conventional wisdom and make sure we're thinking about facts and not just relying on sort of rules of thumb as we invest. As earnings in the economy downshift into low growth mode, typically outperforms value in those situations. Growth has outperformed value in recessions going back to the 1980s. The same is true in slowing economies. So whether we actually get a recession or we don't have a recession, if the economy is slowing down, growth tends to outperform value. And the reason for that is fairly straightforward. So traditional value stocks like banks and energy, utilities, old school stuff, they need the overall economy to grow in order for their business to grow, which makes sense. They're not innovating. They're generally moving fairly slowly. They need the economy to grow in order to take market share and to make more profits. On the other hand, growth companies, they're building new business, they're acquiring new customers, and so their businesses are going to grow regardless of what happens in the economy. And so it's key to let history be your guide as we go through potentially a slower growth period or a recession, and let that guide how you position your stock portfolio, not sort of rules of thumb that would say, hey, we need to be conservative going into a recession and, sort of buy maybe stodgy old companies, because history shows that they actually underperform during slower growth environments. It's also important to think carefully about what's in your portfolio during rising rate environments. And we've hammered this point home in our forecast earlier this year. We're talking about it again today, but this is a really, really important concept. Many individual portfolios still look like something on the left-hand side of this page, which is like 60% in stocks and 40% in bonds. Institutions have been way more diversified than this for years and years and years, for more than a decade. A truly diversified portfolio, especially when rates are rising and likely higher long-term, is more like what you see on the right-hand side of the chart. Investors should own assets that do better when inflation and rates are higher, and that includes things like commodities, real estate, infrastructure. More diversification into assets beyond stocks and bonds is key to building a solid, well-diversified portfolio. If your portfolio is a couple of target date funds and simply stocks and bonds, it's time to move past that to a new, more modern era type portfolio. And to further emphasize the point, I just pulled a couple of examples. Commodities are up materially this year, so I didn't include that because I think everybody sort of has a sense for that. But infrastructure and credit, they're less well-known examples in that diversified portfolio. Infrastructure investments are flat to up slightly so far in 2022, which is what we expect in inflationary environments. Stocks and bonds are both materially lower. So on the left-hand side of the page, infrastructure is the blue lines, a couple of different types of infrastructure investments there. And on the right-hand side of the page, you'll see private credit has produced positive returns so far this year. And that's really because private credit, unlike a lot of core bonds, tend to invest in adjustable rate type structures. And so as rates increase, the rates on the underlying debt payments from the companies increase, and so the returns are more steady. So diversification isn't just a nice euphemism, and it's not just a pie chart. It really helps drive risk-adjusted returns over the long term. And it's something that we're working with our clients on and you need to be thinking about in your portfolio. So lastly, my favorite asset class, cryptocurrency, because stocks are boring now, right? What about crypto? And I think many of the former darlings have moved on because everybody loves crypto when it's up a ton and then they hate it when it goes down. Our position doesn't change, and it hasn't changed on cryptocurrency since last year. We viewed crypto last year and all of its underlying sort of Web3 infrastructure as akin to a venture capital investment. Lots of volatility and a lot of risk. Perhaps it pays off big in 10 years. Perhaps it's flat or worthless. Either way, the volatility demonstrates that it's not a long-term store of value and you shouldn't own it as a core part of your portfolio. You should own it sparingly, if at all. Blockchain's real, the associated sort of technology transformation is real, but the assets have not demonstrated that they're anything other than sort of a long-term bet on new technology, which is, again, like venture capital. So again, we own things like that sparingly in your portfolio, if at all, and it shouldn't be a core part of what you're doing from an investment perspective. Okay, so what do we do in light of all of this? We always try to boil it down to a couple of things that are practical that you can walk away with and implement yourself or work with your team to implement in your portfolio. And the first is to diversify into a modern portfolio. We talked a little bit about what that is, but it's getting beyond stocks and bonds, commodities, infrastructure, private credit. There are lots of other asset classes that you need to be thinking about as you construct a portfolio. Tax loss harvesting also is really important right now. This is another area where the rules of thumb can sort of get you in trouble. If you're investing in a taxable account and you sort of have this rule of thumb that, it's only a paper loss if I don't sell it, so I just won't sell anything. You should be selling to capture the loss for tax purposes and then replacing that asset with something that's similar but not identical. And the rules there can be complex, and you want to make sure you're working in a taxable account, not in an IRA. So I would definitely talk to a professional before you start doing this, but it's important to be taking those losses, realizing them so that you can use them to offset future investment gains and potentially income as well. And then the third thing is rebalancing. Calling market bottoms is really hard. A lot of professionals these days will tell you there's a 50% chance of a recession. I've heard sort of as rates go up, we're going to have a hard landing, a soft landing, a kind of bumpy landing, a landing without the landing gear, all kinds of landings that might happen. And all of that is really no more helpful than sort of flipping a coin or listening to the weatherman. What you can do that's more proven over time is to buy depreciated assets and sell appreciated assets. So rebalancing. And that discipline, even in this market, is the best chance you have to buy low, sort of sell high systematically over the long term and through market cycles. So take a look at your asset allocation, check to see if it matches where your objectives are and where your investment plan is, and take action if it doesn't. And if you don't have a really good, solid long-term investment plan, that's where you need to talk to a professional so that you have something that you're comfortable with rebalancing into over the long term. We do each of these activities on behalf of our clients every day. If you're not sure how to proceed, it's super easy to schedule a call with us to get real professional guidance. There's a link in the video notes that you can use. There's no sales pitch. We won't even let you sign up to work with us. If you ask on an intro call, that'd be weird. We just met. It's like going on a first date. In an intro call, we just ask a lot of questions. We want to get to know you, understand what your situation is. And then at the end of that, if we both feel like there's a fit, we'll reconvene in another and have a more formal proposal for how we can address your particular situation. So no pressure, but if you want professional help, if you want professional guidance implementing into this, schedule an intro call. It's really easy. Why do our clients love working with us? It's really simple. We put our time-tested beliefs into practice. We believe in being good stewards of capital. Either you take control of your money and do the things that are going to lead to the outcomes you want, or your money is going to get control of you. We believe that quality financial advice should be really easy to consume. You should be able to work digitally with professionals, but you should have a person that you can build a relationship with. And expert personal guidance should be combined with intuitive digital tools to make it really easy. Advice needs to come from a fiduciary that's solely concerned about your interest. If you're working with somebody who has a series something license to sell you things, they're probably doing that. And advisors shouldn't be compensated for selling products to you. They shouldn't be compensated for selling insurance or other securities. They should be compensated for giving you advice that's going to help you get where you want to go. And that's what we try to do for our clients. And we also believe that you should understand how your portfolio works. You're in the driver's seat. It's your money. We're your professional advisors to help you get where you're trying to go. So those are the things that we implement. And that's why our clients love working with us every day. Thanks for listening. Feel free to reach out if you have questions. We help fix broken portfolios every day. We'd love to help you if you have questions. Have a great day. The commentary provided is for general audiences and educational purposes only. It should not be construed as investment, tax, or legal advice for your specific situation. That's why you should talk to a professional. Hello. Past performance of market results is no assurance of future performance. All the information on the podcast has been obtained from sources we deem reliable as of the date of this recording, but it's not guaranteed.